Can anyone explain to me what an intentional defective grantor trust is? And how does this strategy allow a family to take full advantage of the gift tax exemption without losing control of the gifted assets?
The
Well,
IDGT. That's what they call it, the IDGT.
The IDGT.
Right.
And basically, an IDGT is a schizophrenic trust. It's a trust where, for income tax purposes, the grantor owns the asset. For estate tax purposes, the trust owns the asset. And the intentionally defective part of it is there are provisions that you put in a trust that make it a grantor trust, such as the ability to replace assets is one of them. So the intentional part is where you're going to do something so that it is a grantor trust, so the income is taxed to a grantor.
Can I add something?
Please.
Yeah, so,
Please.
I mean, look, it's amazing that this technique exists. You know, if you really think of things the government could try to shut down, and they tried to do it, you know, because you have what Richard just said, you put an asset in a trust, and it's outside of your estate, and all the income that the trust earns, you as the grantor pay taxes on it, which is like additional gifts that you're making to your children and your grandchildren, because the asset's growing, let's say 10% a year, and there's 4% of tax, you're paying it out of your pocket. And then the other thing that's great about it, Richard mentioned about, you know, swapping of assets, is that you put an asset in there, you get all of this appreciation out of your estate, but that asset's not going to get a step up in basis when you die, and you may want to sell it. So what you do is you take that asset and you swap it for another asset, and you bring that asset back to your estate, which will get a step up. You've already gotten the appreciation out, and now you put an asset in there that may have a much higher basis, so it doesn't concern you as much that you've lost that step up in basis. So there's tremendous flexibility with it.
About 40 years ago, the IRS got upset with a person, a grandfather, who took $100,000 with 17 grandchildren, and he put $100,000 into 17 individual trusts, so that the trust would pay very little income tax because it would be a fairly low bracket. So in 1985, the IRS published a revenue ruling, 85-13, and they said, all of the income from these 17 trusts is going to be taxed to the grandfather because he has retained certain controls over it. The power to substitute assets, for example. And that resulted in the greatest estate planning boom we've ever had. The last 40 years, the IRS have given us this ability to transfer assets out of our estate, let them grow estate tax-free, and pay the income tax on those gains with our taxable estates, so that a $20 million estate can be reduced to 10. And then when you need money from the trust, you can borrow it back. It's great.